Hello, this is Professor Kent. This is our part 2 of our recording for leases. We left off with just preparing at the question 2 of our example 1, where we just prepared our first journal entry, and I was trying to record the second entry and something happened to my system. So then I had to start a new recording. So in this recording, we're going to be continuing doing the chapter that we were doing the chapter. So now in this example, we are recording the executory cost. We are recording it under IFRS, and then we will be recording it under the IFRS, ASPE and IFRS. So if we were using the ASPE in order to record our cost, will be that debit will be an expense. It's in a maintenance cost, T and maintenance expense, and credit will be your cash for $2,000. And IFRS will do the same entry. It does not matter. It's an expense entry. So it's just to maintain the vehicle or the equipment. We need a maintenance cost. So then the maintenance expense will be 2,000 and cash will be 2,000. So this is how you record an executory cost of the that is built within a lease. So then next, it's just like an obligation. If it's an obligation, we have to do an amortization table. We start with the present value of the table. In the table we start with the present value and the lease payment. We already calculated it when we calculated our minimum lease payment. They told us our lease payment was every year is going to be $23,981. So we're going to go ahead and finish this table. I'm not going to finish the whole table, but I'll show you how to do just the first year and how we can record the accrued interest and the depreciation expense for that year. So when you're doing the lease payment, our lease payment, we know that when we signed the lease, which is on the January 1st, 2020, our lease payment was $23,681.92. There was no interest on the lease payment, and then we reduce our lease $23,682, and that gives me a reduction. So this was what we started off with. That was the present value of all the payments. Now we're making the payments. We made the first payment, so that's your balance now is $16,018 and 32 cents. Now the following year we have your lease payment does not change from you are going to make an equal payment, so that stays the same. And the next year our interest is recorded at 10%. So my liability that is outstanding is $76,018.32. If I multiply by the 10%, I will get an interest of 701.84. So difference between the lease payment and the interest is your principal reduction. So this minus that will be, then now my reduction is 6379.78. So you continue doing it, and then you come up with your balance. You come up with a carrying amount on this table. So what you could do is you could finish this table. What I'm going to show is I'm going to show you how to journalize for the first year. The entry doesn't change. If you have this table worked out, then it becomes easy. So now then it becomes 59,638 and 60 cents. So if you need to you can complete this table. If you need to check your answer with the table, you can go to your page chapter 20, page 22 of your chapter 20 book. Now what I wanted to do is I wanted to show you guys, show you all how to record an accrued interest and a depreciation. If we recorded the lease as a capital lease, that means we booked an as a asset in our balance sheet. If you have an asset, you have to depreciate that asset. In this case, the company is using a straight line. If you go up to the top, the company is using a straight line amortization to record their equipment. So let's do that. So first is you record the accrued interest or this payment. So if you look at it, our accrued interest is on December, which is for our next payment. Our first accrued interest entry will be, we're going to do it under both, we're going to do it under the ASPE, and we are also going to do it under the IFRS. So let's do the ASPE first. We're recording an interest expense. So you debit the interest expense. That will be 7601.84, and then credit, since it's an obligation. So your obligation will increase. You have an obligation under lease for 7601.84. So we recorded the asset in our books was for 100,000. So we have to depreciate that asset 100,000 divided by the life, which is 5 years. Now that will give us the 20,000. So you're going to do that, but the depreciation, your entry, that what you done before in the previous accounting courses, it stays the same. In this case, when you're doing a depreciation expense, you have to do equipment under lease. So I put AD. AD is for accumulated depreciation expense. And how much is that? That's going to be your 20,000. Now I wanted to know, in this case, both the lease term and the life of the asset, they both are same. What if they weren't same? So I'm going to put it in here, and that the others I'm going to put it in this side. So under the ASPE, when we have first one was a title transfer. The second one was if we go back here to here. Now, if now we have a title transfer, bargain purchase option, you have an economic test, and you have a recovery test. So when we're doing the title transfer, when we do the title transfer, sorry, I'm going to go back to where I was, because that's where I wrote it. So when you do the title transfer, and then if bargain purchase option, if these two options, if we said yes to these two options, then we amortize the asset over the life of the asset. So the life of the asset, whatever the life of the asset is, if the present value of the lease payment was met, or the 90% of the when you did the economic life test, if these two criteria was met, then it's on the lease term. So whatever is the lease term, you amortize your asset on that. So if your first two, if the title transfer and the bargain purchase option criteria was met in order for you to have a capital lease, then you will do it over the life of the asset. So let's erase this, so you don't need this. Okay, so, and now we're going to record the accrued interest under the IFRS. So of course the beginning will be your interest expense. That does not change under the IFRS or ASPE. Your credit will be, instead of the obligation, it'll be lease liability. And how much that is going to be? 7601.84, 7601.84. Then you're going to record your depreciation, which your depreciation does not change. You have a depreciation expense of 20,000, and then you have an accumulated depreciation. Here will be a right to use an asset. So you're going to use accumulated depreciation will be your right to use an asset, and that will be your $20,000. So that will be, every year your depreciation is on a straight line method, so that this entry will be same every year till your 5 years that it's on. The only thing that's going to be changing is your interest expense. Your interest expense will be calculated on the liability that is outstanding. So this outstanding amount is going to be decreasing. If this is a decrease in your interest expense that you record, will also be decreasing. So that's the only difference, but your debits and credits will not change when you are recording your accrued interest. So let's see now. Now this is, we're going to go to our example 2. So in example 2, the only, everything else is same. The only thing, it's the same example. We are going to, what happens now, if you look at it, I put it I bold this part. If the residual value is guaranteed, the only thing changes is your lease payments will changes. If your residual value is guaranteed, means lessee is guaranteeing that the value of the asset at the time of the return, the asset will be worth the $5,000. So if it is going to be 5,000, then we are if we are the lessee, we're guaranteeing that 5,000. So the only thing changes is your present value of your present. The only thing that changes is your present value, and your lease payment will change. So let's see if we are able to calculate the lease payment under the IFRS and under the SP. In this case, the question didn't tell us that what the lease payment are going to be, but we could figure out if the lease payment is not given. So the way to do it is, if you look at it, whatever, if you are a lessee, you're going to be making a payment what the lessor tells you to make a payment. So in other words, lessor is going to recover all its investment through a lease payment. So this is this is the way to do it when residual value is guaranteed. If residual value is guaranteed, how do we record the present value of the how do we calculate the present value of a lease payment, or what the lease payment is going to be. So now if we know that now, if the way to calculate it, you're going to calculate investment in leased equipment. So the lessor made this investment. Lessor made an investment of 100,000. That's what we want. What the lessor company wants to recover a fair value of the investment. The investment they made was 100,000, so they're going to recover. But they are promised that the residual value is guaranteed. The lessee is going to guaranteeing them the 5,000. So that will be 5 years from now. So you have the present value, that residual value. So this is what happened, present value of residual value, because it's guaranteed. So what it will be that, so how you calculate present value, I'm going to put it in here. Your future value is going to be your 5,000. Your N is going to be 5. Your IY is going to be 10. Your payment in this case is 0. You're going to compute your present value. That should come to 3104 and 61 cents. So if it's going to be guaranteed, that means the lessee is going to give it to them. So the payment will be calculated differently. So the payment will be calculated using this is what the present value of the lease payment is going to be. Now, if we know this is the present value of the lease payments are, this is how you calculate the present value of all the lease payments. But we don't know how much each lease payment is going to be. How we're going to calculate that? We know it's due at the begin mode again. So what you're going to do is you're going to do your present value. We already know it's 896.80, 96, 895 and 40. N is your 5. Your IY is going to be 10%. Your future value is going to be equal to 0. You're going to say compute the payment, and then you're going to come up with the payment, which is going to be close to 23,327 and 9 cents. So this will be the payment that the lessor is going to recover from lessee. So the reason why we had to do that, whatever the payment lessor decides, we agree to that payment, and that's going to be the payment we calculate it that way. Now let's say prepare the journal entry to record record on the lessees corporation's books. Again, we are doing the same thing what we did. The entry doesn't change. Now our payment changes, so the amounts will change. So we're going to do it under both. We're going to do it under ASPE, and we're going to do it under IFRS. I'm repeating myself here because what we want to do is we wanted to keep doing it over and over again, so that we will be able to calculate it. We know the investment is 100,000, so that doesn't change. The only thing changed here was that we have a payment that changed. So let's work out under SB. So we know our cash payment, that the first payment will be 32709. We have a obligation under lease, which will be 76762.91, and then your equipment under lease, 100,000. So now now if you look at it now, our debit didn't change. The only thing changes was our payment. If payment changes, our obligation changes. So then under the IFRS, we're going to do the same thing. We have a right to use asset, which will be your 100,000. Then we have a lease liability, which is going to be 76762.91, and we made the first payment when we signed the lease, which is your 23,327 and 9 cents. Now we're going to go forward. Then next part is to record your executory cost. Your executory cost is 2,000. That didn't change from our previous example. So in this case, we have a maintenance cost, which will be your 2,000, and you have a cash of 2,000. And we're going to do the same thing here under the ASPE cost, which is going to be charged as an expense, and then you have a cash of 2,000. Again, cost, it will be maintenance expense, that'll be charged to that. Now if you now prepare the lease schedule, we started with 100, we're going to end up with 0, but lease payment changes now. Our lease payment is now 23,237.9. there's nothing. First one, 23709. If that changes, our lease payment is going to change. Our lease payment is going to make our obligation change. So in this case, it should be 76,762.91, and we calculate our interest. Our interest is 10% of your obligation, which is going to be 7676.29. Our payment does not change, but your reduction to your obligation did change, because now we paid some interest in that, so which is going to be 5560 point your point 880. I think I rounded up to 32 or 2. You can round it up to 1 if you don't want the 2 decimal places. But if you're doing it on Wiley Plus likes 2 decimal places, so you want to stick with the 2 decimal places to make your life easier. So then you can go ahead and complete the table. If you're having a hard time completing the table, you can go to page. This table is on your. This table is on your book, page 26. So if you go to page 26 on your chapter 20, this is where the table is. You can go and complete the table, and then you can check your answers. Now, every year, doesn't matter if it's residual value guaranteed or not guaranteed, or it's 0, a residual value is 0. We still have to record an accrued interest using the IFR. If the company is public, then it's IFRS. If the company is a private company, they will be using the IFRS. So what we're going to do is we're going to make an entry, debit the interest expense, credit your obligation under lease, which is going to be 767629, 767629. Then we go to our next part, which is our depreciation expense entry. Now if you look at our depreciation expense entry will change now if the residual value is guaranteed. What will change? We have to, if residual value is guaranteed, then we have to minus the 5,000 when we are calculating our depreciation. In this case it will be 19,000. So the difference between the residual value is, if the residual value is 0, then we don't need to worry about it. If residual value is guaranteed, we have to include it in our calculation to calculate the depreciation expense. So you're going to debit the depreciation expense, credit your accumulated depreciation. In this case it will be equipment under lease, which is going to give you 19,000. Now we're going to go to IFRS. Your interest expense entry does not change, so you debit the interest expense of 767629, and you have a lease so you have a lease liability. Then we have the depreciation expense, and we have an accumulated depreciation. Here is right to use an asset. The entry, the number will be same, so you have to account for it. So how you journalizes, the accounts are different. How you come up with the numbers, it does not matter from one method to another, one IFRS method to another IFRS method. Now this leads us to next example. So now in this question, residual value is guaranteed. The first example we did with the residual value was 0. Now we're going to show you what if residual value is unguaranteed. In this case they told us the residual value, but it was unguaranteed. So we wanted to show you how to calculate the payment. In other words, if the residual value, if the payment is given to us, leasing company does not need to worry about the residual value, but lessor has to worry about the residual value. But we're going to show you how to calculate the lease payment, because from the lessor point of view, we needed to show you how to calculate it. So now we know that the question, when we calculated present value of 5 annual lease payment for the residual value to be recovered. So if it's just exactly similar to the question before, when we calculated the residual value, we knew our payment came out to be 96,895 and 40 cents. And then what we're going to do is add the value of unguaranteed residual value. If it's unguaranteed, we don't do anything with it, so we make that 0. Leasing will capitalize it. Only if the residual value is guaranteed, then we have to add it, otherwise we do not need to add it. So that will be 96,895.40. Now you see the difference between the question that we did before and this question is the what do we do with the residual value. In this case the residual value is unguaranteed. If it's unguaranteed, we don't include it in our depreciation calculations, and we do not include it in our payment. So this is they're saying this is what the capitalizes. Now that becomes your present value of your lease payments. So that's how. So the payment, I should have wrote it down. The payment was 23,237.09. That's what we calculated in our previous example. If you don't know how to calculate this, I showed you how to calculate it in our previous example. The leasing company is going to make 5 payments of that. That will give you 96,895 and 40 cents. Now how do we record the journal entry? Again, we're going to do both SP and IFRS. We are just repeating our ourselves by showing you what if one thing changes, how the impact will be on your journal entries. So that's the only thing will make a difference is on the journal entries. Nothing else is going to change. So let's do the entry under SP. It will be equipment under lease. That will be your 96,895 and 40 cents. We made the first payment, which will be your cash at the beginning. At the time you sign the lease, our payment is going to be same. And then you have a obligation under lease, which will be the difference between those two, 73,658. Then we are going to go back here. You're going to do your debit, your right to use an asset. So that's your IFRS, and they follow the IFRS 16 rule. So debit the cash. Your cash is going to be 23,237 and 09, and then you have a lease liability. So this is your 96,895 and 40 cents. If you, this is my debit and this is my credit, and that's also my credit for the 73,658. And you might have some cents. I didn't calculate the cents. Then what your other entry, executory cost, will stays the same. I'm not going to write it at both places. It's just a maintenance expense, and credit your cash of 2,000, and this is also 2,000. So the entry is same under both, under IFRS and under the ASPE regulations, rules and regulations. Now if we calculate the present value of our lease payment, that's what we, now this is different. The other two examples we started with 100,000. In this example we starting with 96,895, and our payment is the first payment is due 23,237 and 09. And then what we're going to do is, that's your first payment, and then the second payment will be you have 2323709. I think it's 73,658 and 31 cents. So our next ones, our lease is our interest will be 10% of our obligation, which is going to be 83. And then you have 15,871.26. That gives you 57,787 and 5 cents. So you're going to go ahead and complete this table, and once you complete this table you can check your answer in your book, and it is listed on page 2027 if you want to check by completing this. So by the end this will be 0. So now, of course, if your payment changes and your interest will change, if your obligation changes, your interest will change. Then now we're going to show you how to well, we already showed you the table, how to calculate it. We're going to record under the ASPE, and we're going to record under the IFRS. Under here we have a interest expense, then we have an obligation under lease. What will be that? 7365 and 83 cents. 7365. You have to complete this table in order to answer. In the Value Plus quizzes, you could be asked to do an interest expense somewhere in 2014 or 2020. Depends on what is asked in the question, so you have to follow what the question is asking you to do. And now we have a depreciation expense. Now if you look at it, we recorded the equipment under lease for 96, so our depreciation will be recorded on what we recorded in our books. In this case, which residual value is not guaranteed, so your residual value is 0 divided by the 5, give me a depreciation for the year, which is going to be 19,379. Then you have an accumulated depreciation equipment under lease, which is going to be 9379. So now this entry does not change, they both stays the same. Here this entry changes because your debit is your interest expense. However, the credit will be your lease liability for the 7365 and 8373. So this is how we can calculate it. Now this is where if they have a capital leases. Before I go to the example 5, I just wanted to refresh it. Under the IFRS, they follow IFRS rule 16. Under SP, you have quite the criteria is that you have to test the lease to see if it's an operating lease or a capital lease. If it's a capital lease, you need it to title transfer, bargain purchase option. You're doing economic life test. Then you have a recovery test. So you have to do all these tests. We only have to, one test has to be yes. The if one test is yes, you know it's the lease is a capital lease. If first test is not yes, then you have to go and test the second one. If that's no too, then you test the third one, and then you test the fourth one. If they all of them come back with a negative, then it's not a capital lease. It is a then it becomes as an operating lease. So we have to you have to go through each the criteria. Only one of this test has to be met, not all of them. So one has to be met in order for it to be a capital lease. Under the IFRS, all leases are all leases are capital lease except only if it's a short term. Short term will be less than 12 months or a low value lease. So then, like I said, I given you an example of low leases was that if the company is buying chairs or mobiles or water coolers, those are, they'll be charging it at low value, they'll be expensing it. So that now we have gone through this recording and the last recording about capital lease with residual value guaranteed, residual value not guaranteed, and then zero residual value. So we gone through 3 examples, so you have to go through those examples. If you go through those examples, you shouldn't have any issues with this. Now we're going to, now this the next part of the example leads us to, what if none of that criteria is met under SB and under IFRS is a low value lease? How do you record it? Now, so we know that now the questions, it's the same questions, but we just converted into it so that it qualify as a low value lease instead of a capital lease or a right to use asset lease. So assume in example 2, value of the equipment is lower value, which is 1% of the amount. So the value of 1% of that amount is 981, should be 239.82. So the value of the lease is 239.82. That means a low value lease and it's a short term lease. How would you record this lease under the IFRS and under the SB? So that's what we're going to be learning in this example. So this is, and if it's an operating lease, that'll be off the balance sheet leases because you don't have to record it on your balance sheet. You will then be recording it on your income statement instead of your balance sheet. So let's see how we record it under IFRS and how do we record this lease under the SB. So when we make our first payment, of course, we have to charge it to the prepaid rent because at the beginning of the month, that will be done on January 1st. So January 1st, you will be making a payment and it will be a cash of $239.82. Now under the IFRS, the entry is same, there is no change. So it's a low value lease and it's a prepaid rent, and credit will be your cash of $239.82. So once we done that, now of course we have to record the adjusting entry at the end of the year. So now the So the leases, we already made a payment. We made a payment on January 1st. So we made a payment up to December 31st, and December 31st we used this low value equipment. So now we have to do an adjusting entry at the end of the year. So now we made a payment here. Now we needed to do an adjusting entry here. So what we're going to do is we're going to use IFRS and ASPE and record this adjusting entry. So let's do under ASPE, we will be charging it to the expense, and we'll be taking it out of the prepaid rent account. So these are adjusting entry which you learned in your ACCT 2001 course, and you repeated it in that, and then you also in your first accounting course. In this case, you have to take it out of the prepaid. Now we use that asset, so it's 239.82. Now under the IFRS, you will debit the rent expense and credit your low value. Sorry, my mistakes. I got carried away with my rent expense. So of course your credit will be your prepaid rent, which will be 239.82, and your debit will be your low value lease expense. So if the asset is not if it's not a capital lease, the entries are very simple. All you have to record is record the prepaid expense if it's paid at the beginning of the year, and then you have to adjust it at the end of the year by recording an expense entry. Operating leases are very easy, where the capital leases are not easy. They're a little bit complicated. So what I do is I recommend you going through all the leases, the examples that we have gone through it. If you have any questions, post it into our discussion board under chapter 20 under leases. I will have another recording for there are two more type of leases that are left. We're going to be using the same example, and we're going to be using those two showing you those two leases. For the exam purposes, I will if I were you guys, concentrate on the capital lease under both IFRS and under the ASPE standard. So you have to learn both. And there you might be asked a question regarding operating lease, just a multiple choice question. It won't be a big question. For capital lease, you're going to be asked a big question in your assignment and in your first test, if when you're working on your first test. So I recommend going through it. Try to understand what do we do when the residual value is guaranteed, what we do it when we do residual value is unguaranteed, and what we do if there's residual value is zero. In other words, if it's zero, we don't do anything. If it's unguaranteed, then we have to do something about it. That's it for this recording. I will have another recording for the two other leases that we didn't go through. Go through these both recordings again. If you have any questions, send me an email or post it in the discussion board. Thank you for listening to me, and I will end here. Thank you.